Hello and welcome to Pro Trader Strategies market commentary for Friday, February the 28th. It has been a crazy week out there. I'm Eric Wilkinson, and you very well may recognize me from mainstream media where I've talked about economic data, how that impacts the overall markets, and throw in some of that geopolitical stuff. Global markets right now in turmoil over the coronavirus, you guys. It is kind of crazy to think that this is really bringing down the markets. We were due for a correction. This is part of that as well, you guys. But let's talk about some of the economic data real quick. All right, across the pond, we got German import prices. Those came off just a little bit by 0.4%. We also got retail sales out of, forget about those retail sales. Those are out of nowhere, really. Back here in the United States, let's talk about us anyway. We got core personal consumption expenditures, which is PCE price index, that came in a little bit lower than expected at 0.1%, expected to be 0.2%. Personal spending came in at 0.2%, a little bit lower than the expected 0.3%. They did revise last month's number up to 0.4% from 0.3%, so that's a good to see anyway, I guess. Personal income ratcheting up nicely to 0.6%, expected to be 0.3%. That's going to be a catalyst of full employment. Now, if an employer wants to hire somebody, they're probably going to have to pay them more. Wholesale inventory is coming off by negative 0.2%, expected to be positive 0.1%. And they revised last month's number off a little bit more to negative 0.2%, expected to be negative 0.1%. University of Michigan consumer sentiment coming in at 101, expected to be 100.7. And Chicago PMI, Purchasing Managers Index, coming in at 49. It's still below 50. Anything below 50 is recessionary, but it was much better than expected at 40. Expected at 46. So nice to see that trending towards that 50, which is the line of delineation between recession and expansion. Now, something to note with these numbers, you guys, this is before this coronavirus, right? So consumer sentiment, all of these things could really change on a dime, as we're seeing that getting priced into the equity markets right now. So even the markets didn't really flinch at those good economic data points because they know those are kind of behind us and we have to look forward right now. Now, let's take a look at the markets, how this coronavirus is impacting us. We got the crude oil markets continuing to slide here, down below 45, way below my Fibonacci 46 area, which looked like it was going to hold yesterday. It did hold yesterday, but then we just broke down again today as the equities have fallen. Basically, the Dow Jones was down another 1,000 points today. We just had an 8-minute rip your face off rally, 400-point rally in the Dow, and then it took another 8 minutes for it to sell back off 400 points. So volatility going through the roof. We've got gold coming off, though. This is, really probably blowing people's mind back below 1,600. I think what's happening here is we're seeing some people, institutional people, taking the money out of that safe haven in gold, throwing it into the equity markets at any given time. That's why we're seeing these markets really massively move back and forth. Bonds moving higher like crazy today. You can see up over 2.5 points right now on the day. When we were near those highs, we were seeing yields at 1.16. Fed fund futures pricing in a possibility of a 50 basis point cut at this March meeting. Even people are talking about an emergency rate cut of 25 basis points Sunday night. Listen, you guys, I'm not talking my position. I would love to see them cut the rates because that would help the equities just as a psychological thing. But it's not going to cure coronavirus, you guys. We need to really see if we are going to see a massive slowdown and dent in the economy, actually. So, yes, it is going to slow a little bit, but is it really going to throw us into turmoil? And if they cut 50 basis points right now, you guys, then they don't have anything to do when the market really starts slowing down. We're seeing people, refinance. We're seeing new home sales I don't think that people are going to stop that. Yes, people might stop flying and traveling overseas, but here in the United States, I don't know that we're going to see that much at this point. But crazier things have happened. All right, the VIX in the 40s, you guys. I threw this up on a 3-year chart here so you could get like where this has been. We can see that it has a tendency to push up here maybe once a year or so. So we're seeing that push up there. This is basically saying 3% daily moves going on. Dow Jones Industrial Average, this is what I'm talking about. We're down down 680 points there. We were down close to 1,000 points earlier. If I throw this up, this is on a weekly chart, sorry. Let's throw this up on a daily chart. You can see just a massive whipsaw going on here, and then I'll throw it on a 5-day, 5-minute chart. You can see this rip your face off rally that I was talking about, and then now starting to rip ourselves off to the downside. So we even, I think, saw E-mini S&Ps move into close to positive territory at one point again today. So we can see that the NASDAQ off by about 40 points, but when we check out the lows there at 81.26, you can see that was another 110 points lower than where we are now. So, we were down over 150 plus points earlier today. Now, E-mini S&P is off by about 46, but you can see well off the lows here. Hopefully, we're making a little bit of a bottom. Came down and touched the points of control here. Definitely below the 200-day moving average, which is very bearish. Let's take another look at that NASDAQ because I want to talk about it real quick again. Came down and tested the 200-day in itself today and bounced up and away from that. So not near its point of control, which is much lower there. But again, seeing some moves in these equities where maybe it's starting to feel like a little bit of capitulation has happened. Hopefully we're not going to see another shoe drop over the weekend and really push this down. Coronavirus, something about that again. Guys, remember, it is very contagious. There are actually a lot of people are, even throwing it out there that 60% of the people will get it. That's how contagious it is. But the mortality rate is extremely low. So it's not like people are dying from this. Bottom line is, if you're feeling sick, stop shaking hands and stop going out and stop coughing on people. All right. Here's another look at that rally off the lows. We did print some lows during the day session, but then we got that rip your face off rally in about an hour and a half. This is the big rally right there. That was what happened in less than 10 minutes. This is on a 30-minute candle here though. But that just rip your face off rally and come back off. So gold coming off. Bonds, yes, they are extremes right now. Seeing the equities come off, that might be the signs that we have slightly bottomed. Now, let's talk about some of the trades that I've done. Yesterday, I went into Coca-Cola. Basically, right after I got done with the daily market commentary and talking about Facebook and things of that nature, I decided to go in there and throw in some more trades. Feels like I'm catching a knife, which I might very well be. But these are stocks that I think are going to survive recessionary type things, and especially like a coronavirus. Maybe not necessarily Disney, but let's talk about Coca-Cola. I went in and sold the March 53 puts in there. You can see I'm right there at break even with this massive drop, and yesterday's sell-off, exacerbated. I think I sold those puts when we were trading around 55, maybe even a little bit higher than that. So definitely in the money. It looks like I'm going to get that stock put to me if it continues to slide, but I would add that to my portfolio. And then we go into Disney. I decided to go in there. I've been long Disney for a while there, trying to do some cost basis, lowering of my cost basis, and by selling those 160 calls that I've been doing several times. So I've lowered my overall break even in this to about 145. Well, we have seen a massive sell-off here, so I decided to go in and sell some puts in here and sold the 110 puts in Disney yesterday. for, what was it, $1.03. So that lowers my overall cost basis if I don't get those stock put to me. And if I do, then I've dollar cost average from 145 and the Disney 110 puts. So 145 and 110. I actually doubled up on that. So with the Disney, I'll double up at 110. So lowering my cost basis to around 120 there, or about 125 actually. So with that being said, I did one other thing in Facebook. This was also yesterday. Facebook, I went in and sold the March 175 puts in there for $1.95. And those 175 puts obviously were getting close to being tested this morning, but again, we moved back up to the point of control. I've talked about Facebook doesn't have exposure to coronavirus. And I think I talked about this in the webinar yesterday where we were talking about long calls. Facebook is kind of immune to this virus, right? Because if people aren't going to work and people aren't going out and they're staying at home and they're putting themselves in quarantine so they don't get sick, well, they're Facebooking. So that should help out Facebook to the upside. And if somebody puts that stock to me at 175, I'd be happy to take it. You know, it's down here at this support level. So with that $2 credit almost that I've gotten, my break even on this would be about 173. You know, so dropping it below the value area. We're at the point of control right now, so I think it's going to hang on there. I'll be able to collect that credit. Not a whole lot of powder dry for me right now at this point. And then finally with DAL, obviously they've been getting beat up. I'm synthetically long in DAL. Remember I did this and then got short United in some calls. It's not really, the calls aren't necessarily helping me out because you can see the airline stocks are seeing some incredible implied volatility percent, just ferocious to the upside. But again, taking advantage of some high implied volatility, I'm long this around 60. Well, I was able to sell calls in here in the April, went into the April and sold the 60 calls in there for 52 cents. Lowering my overall cost basis. I'm staying mechanical through this, you guys. We need to take advantage of this high implied volatility, as you saw with the VIX. You know, maybe happens once a year. You kind of gotta, you know, when there's blood in the water, start going fishing. And yes, it does feel like you're catching a knife sometimes. But if we are staying mechanical, selling some puts, looking to add to our portfolio some of these stocks that we think are solid, then that is a very structured way to trade. And you know, that's what I'm doing. I'm trying to stay mechanical through this, trying to keep myself in the game and not panic. All right, so anyway, not panic with the pandemic. Please go over this disclaimer. We have to talk about this because past performance of any trading system or methodology is not necessarily indicative of future results. We are not trying to give you trade recommendations by me talking about my trades and what I'm doing. What I'm trying to do is give you real life scenarios to educate you on what people do with their portfolio, or at least what I do with their portfolio. So keep in mind, we are an educational company and are not trying to give you trade recommendations, especially during a time like this. So pause it and check this out. That's all I got for you guys. Have a great weekend. But if you can't take that, take it easy.